Take a look at this commercial district. When properties scale to this size, the rules of acquisition change. In appraisal practice, a building's physical structure is secondary. Its value is determined strictly by its capacity to generate future economic benefits. This relies on the principle of anticipation. Investors acquire these assets expecting two specific future benefits: recurring net income from daily operations and the projected resale value at the end of the holding period. The core question of the income approach is direct. How much is the market willing to pay today for the future income this property can produce? Under this framework, real estate is evaluated strictly as a financial vehicle. The bricks and mortar only matter to the extent that they secure that earning power. To accurately value that earning power, an appraiser must adopt the standpoint of a typical prudent investor. The current owner's personal perspective is irrelevant. This prudent investor has two strict financial requirements. They demand a return on capital, an annual yield, and a return of capital, which is the eventual recovery of their original investment. An owner's actual operating history rarely reflects this pristine standard. It is often distorted by non-market behavior and personal bias. For example, an owner might accept below-market rent from a family member, or artificially lower expenses by managing the building themselves. The appraiser's duty is to strip away these idiosyncratic biases. They must adjust the numbers to establish a sustainable, market-supported operational truth. Taking an owner's unadjusted profit and loss statement and plugging it into a valuation model produces a mathematically precise but entirely inaccurate market value. This reconstructed operating statement filters theoretical revenue into true earning power. It begins with potential gross income, PGI, the maximum capacity assuming perfect collection. We then deduct a calculated vacancy and collection loss. Ignoring this deduction assumes a flawless operating environment, an error that guarantees an inflated final property value. The remaining subtotal is effective gross income, or EGI. This represents the practical, realistic cash flow expected from the property. From the EGI, we make one final layer of deductions, operating expenses. These are the ordinary, necessary costs required to preserve the property's income-generating capability, such as real property taxes, insurance, and routine maintenance. This condensed remainder is net operating income, NOI. Investors do not buy gross rent. They buy the net earning power of the asset. NOI is the engine that drives the entire income approach. Isolating the real estate from the business running it requires strict boundaries. Certain expenses must be excluded entirely. The first major exclusion is debt service. Mortgage payments reflect the investor's specific financing choices, not the operational reality of the physical property. Value is measured independent of the capital stack. Next, we exclude income tax and depreciation. These are taxpayer-specific accounting allocations and tax bracket variables. They are not physical cash outflows required to keep the building running. Finally, capital expenditures. Major one-time structural replacements like a new roof are omitted. Appraisers account for these through annualized replacement reserves to prevent unpredictable spikes in the data. Allowing owner-specific financing or tax structures to bleed into the operating statement corrupts the valuation. NOI must remain a pure metric. Once we have a stabilized NOI, we convert that single year's income into a current lump sum value. This is done through direct capitalization. Value equals NOI divided by the capitalization rate. Our stabilized NOI of 1,108,080 pesos goes into the numerator. The denominator is the cap rate, here 9.5%, pricing market risk. Dividing income by cap rate yields an indicated value of 11.66 million pesos. This formula relies on an inverse relationship. If the market perceives greater risk in a property, investors demand a higher return, pushing the cap rate up. Pushing the assumed market risk up to a 12% cap rate instantly compresses the property value. The cap rate acts as a highly sensitive fulcrum. A minor misjudgment of market risk will drastically swing the final valuation of the asset. Direct capitalization is highly effective, but it only functions accurately when income is highly stable and stabilized. This diagram contrasts a stabilized asset against an asset with shifting dynamics, such as uneven lease rollovers or a property undergoing major repositioning. For volatile scenarios, appraisers shift to yield capitalization, commonly implemented as discounted cash flow or DCF analysis. Instead of capitalizing a single year, DCF projects the precise cash flows year by year. Each year is individually discounted back to year zero, alongside the expected resale price. Direct capitalization offers mathematical elegance, but DCF provides the temporal rigor required when standard stabilization assumptions fail the reality test. Look at any corporate tower in a prime urban market. Regardless of whether an appraiser applies direct capitalization or discounted cash flow, the core doctrinal truth remains unchanged. Property value is strictly a function of net income, perceived risk, and time. Execute the math, but recognize that this approach requires disciplined market judgment to normalize expenses and extract accurate cap rates from actual sales. Properly applied, the income approach cuts through physical appearances to reveal the central economic reality of investment property, its capacity to generate wealth.